Let's get right down to business today, and we're going to talk about stagflation. And this is something that you don't hear about all the time, but it does have a huge impact if, in fact, it does happen. And we're going to start hearing more and more about that. Now, stagflation is when inflation is high, but the economy isn't growing, or in a worst case scenario, the economy is shrinking. We have prices going up, but jobs and wages aren't keeping pace. And that's a really, really tough spot for any country to be in. The reason we don't hear a lot about it probably, the last major stagflation episode that we had was back in the 1970s. And in the time we had oil shocks, we had supply issues, weak economic policies, and these all created the conditions that led to double-digit inflation and very high unemployment. And it took years, and importantly, a brutal interest rate hike from Fed Chair Paul Volcker at the time to break that cycle. You can see on this chart here, the line I have at the top is 20%, and that's around where interest rates topped out. Now, if we fast forward to today, we're not there yet. We're not that bad, but a lot of economists are starting to see some familiar warning signs. This time, both the United States and Canada are showing these symptoms. So let's break down what's happening today. I want to start with the US. And core inflation is sitting year over year slightly higher than where they would like it to be. It might not be at a very dramatic level right now, but it is coming at a time when growth is slowing. The Federal Reserve just revised its 2025 real GDP forecast down to 1.7. That's down from an earlier estimate of 2.1%. The latest IMF report just out also downgrades the US GDP growth. So we have prices rising, we have the economy cooling, and that is the classic recipe for stagflation. Now, no big surprise what's driving this here. It is tariffs. President Trump, he has introduced these massive tariffs across the globe. They're at a level now that we haven't seen since 1910, 115 years since we last saw tariffs like that. And these costs sort of just ripple through the economy. They raise prices for both businesses and consumers. Now, let's look here in Canada. Inflation here has actually cooled a little bit. It was 2.3% in March. That's down from 2.6% in February. Lower energy prices were the thing that helped that the most last month. But here's the kicker. The unemployment rate, it rose to 6.7%. That's the first jump since November of 2024. So again, we're seeing this troubling combo, right? We're seeing slower economic activity, and we're seeing persistent inflation. Real GDP growth in Canada projected at 1.7% for Q1 2025. That is the same as the US. So I do want to go deeper now into why this actually matters so much. And stagflation is so tough to handle because the economic tools that the banks usually use, they actually work against each other. If central banks raise interest rates, they would do that to fight inflation, then they risk slowing the economy further. But if they want to cut rates to boost growth, then of course they risk stoking more inflation. And that is the big challenge that the Federal Reserve and the Bank of Canada have right now. How do they strike the proper balance? When we look at things today, these high tariff costs, they're adding to production costs pretty much across the board. We have businesses facing higher input costs, where they, of course, pass that along to the consumers. Now, at the same time, we have a lot of uncertainty around the trade policy, and that has a lot of companies stalling, thinking or rethinking investments and their hiring plans. Now, in Canada, we, of course, are also facing that external pressure. The Bank of Canada just last week held its key interest rates at 2.75%, and that was after 7 straight cuts. Now, in the monetary report, Governor Tiff Macklem, he called the current situation a once-in-a-lifetime economic shock. Now, I did cover that story in more detail in a recent video. I will put that link for you here. Now, also, the U.S., that's moving towards a more protectionist trade policy. Canada's economy, of course, is export-driven largely, and that could take a serious hit. The more the U.S. locks down, the harder that would be on the Canadian economy here. Now, another possible issue that would make things more complicated is that most of Canada's economic growth over the past year has been fueled by population increases, and now there's new limits on immigration, so that might drive things even slower. Now, I want to look here at the impact this would have on policy, on markets, and on businesses. What are the policymakers doing? Well, the Federal Reserve, it has been hesitant to cut rates, even though it is getting a lot of pressure from both the markets and now the White House. Just yesterday, Trump posted that Fed Chair Powell is a major loser, and now he's openly suggesting that he should fire Powell, even though it's not even clear whether he has the authority to do that. Most experts say he doesn't. Now, why is the Fed so hesitant to cut? Well, this is because inflation, although it is down from the recent levels we've seen, back coming out of COVID, it is still sticky. And if the Fed does move too fast there, that could just fuel a whole nother wave of price hikes. We don't really want to go back there. Investors clearly are nervous about this. You look at the S&P 500 as the benchmark. It has been on a real roller coaster lately. I say that if we do see any further concrete sort of signals of stagflation, that could lead to sharper corrections in the stock prices than we've already seen. Now, in Canada here, it's pretty much the same story. The Bank of Canada is sort of weighing these two different scenarios. First one is if tariffs ease and trade normalizes. The second one they put out was if there is a full-blown trade war with the U.S., if that drags on. That scenario could tip Canada into a full-year recession, according to the Bank of Canada. That would have lasting effects, obviously, on jobs, inflation, and on business investment. So let's sort of bring this all in here. The big question is, are we overreacting? A lot of people think that stagflation talk is premature. The U.S. and Canada still have a long way to go, and they do have room to maneuver. We still have elevated inflation, but it's certainly not out of control. Growth is slowing, but not collapsing. So both of these things are true. But the risk still is real here. And what makes this different from the 70s is how interconnected our economies are these days. We have supply chains that span continents, literally. And tariffs today don't just hit one sector. Right now, they're rippling through everything. We're talking about tech, obviously. We've seen that in the stocks. Food, healthcare. These are the things that we use every single day. So let's look at what might happen next. If tariffs do stay in place and consumer prices keep climbing, then we're definitely going to see more of an economic drag both here in Canada and in the US. In that case, I would expect more cautious consumer spending, slower job creation, more pressure on wages. On the other hand, though, if the tensions that we're seeing right now do cool down, if we see the supply chains recover and inflation start to fall back towards its target, then both economies should stabilize. But that is a lot of ifs, right? And a lot of something else that we're hearing lots about these days is uncertainty. And I find myself saying this a lot lately, but the next few months are going to be critical in this whole equation here. I see both the bank here in Canada, the Fed, they're going to be watching employment data, inflation trends, consumer behavior very, very closely. So should we as investors. Now, I do want to look at what you can do in a stagflation scenario, but first, I want to have a look at two brand new low volatility ETFs that might help you through times like this. Obviously, the markets have been all over the map lately. I don't see that coming to a conclusion anytime soon. So with all this volatility, it's no surprise that investors are looking for something a little more steady. And that's where two brand new ETFs from Harvest come in. They offer a more stable way forward in the middle of all this market noise. First off, the Harvest Low Volatility Canadian Equity ETF, ticker is HVOL. This is focused on long-term capital growth with lower overall volatility, ideal for balancing out high growth exposure. Now also the Harvest Low Volatility Canadian Equity Income Fund, that is HVOI, that builds on HVOL. It has an active option strategy to deliver enhanced monthly income. Both of these funds invest in 40 top Canadian equities. They're selected using a disciplined risk-based approach. The rules-based portfolio construction limits exposure to individual stocks and market shocks. They're designed to navigate inflation, uncertainty, and geopolitical risk without giving up on performance potential, and they're backed by Harvest's experienced investment team. So these low volatility ETFs, they are live now. They're brand new. They are built for investors who are looking for confidence in uncertain times. So if all of this market craziness has you feeling a little bit anxious, you can learn more about these funds by visiting harvestetfs.com. Okay, so if we are headed into stagflation, what can we do about it as investors? Well, if we are truly heading into this period, you need to tread very lightly. And that is because stagflation will hit both sides of the market. Inflation is going to erode your purchasing power, corporate profit margins, weak growth, that's going to drag down earnings and consumer demand. So it's a true double hit in a case like this. If you are fully invested, there's a few things that you need to be aware of. I'm not suggesting for a moment here that you should market time. If you're dollar cost averaging into broad funds, I think that's reasonable, but you should understand at least what's going to happen. And as an investor, if you are fully invested, especially in growth-oriented or cyclical stocks, that can be pretty risky during stagflation. I'll tell you why. First of all, there's equity volatility and slower growth. That's going to lead to earnings misses. High inflation can push up input costs. That leads to profit margin compression. If you have overexposure to risk assets in a very choppy environment, markets can swing quite a bit. They can swing very sharply. If you have no cash or defensive assets, then you have less flexibility. I want to look at how investors can protect themselves. And again, I'm not telling you what to do, but here are a few things that you might want to think about. First of all, increase exposure to inflation hedges. And just look at what's been happening with gold. If you look at commodities like gold, if you look at inflation-protected bonds like TIPS in the US, they do often perform better when inflation is rising. Not always, but often, and we can see lately how gold has actually worked in this regard, you might want to focus on defensive stocks. So things like utilities, healthcare, consumer staples, they do tend to hold up better in tough economies. These are sort of the essential things that people do keep buying even in market downturns. That's more of my style. If you want to see what I'm invested in, you can check me out on the Blossom app. My username there is Mark B. It's free to join. You might want to consider that. Another strategy is to diversify globally. So if stagflation hits North America the hardest, expanding and holding some international companies can help you there. I also think that you should probably have some cash on hand. That gives you some flexibility, and I acknowledge that having cash is not sort of a glamorous thing, but in volatile times like this, it does provide you with that dry powder to buy bargains or even rebalance without having to sell at a loss. Another thing you can do is look for quality and dividends. And companies with strong balance sheets and have a history of paying consistent dividends, they're more likely to weather the economic slowdowns. That's another thing you can consider. Really importantly here, be patient, be tactical. This isn't the time right now to be taking huge bets, blindly making trades out there. You should be focusing on capital preservation, some opportunistic moves, rather than just sort of chasing growth at all costs. What do you think? Are we headed for a repeat of the 1970s? We're just going through a rough patch right now. Drop your thoughts in the comments, and don't forget to like and subscribe for more updates on the economy, events that actually matter in your daily life. Thanks as always for watching. We'll see you in the next video.